For the avoidance of doubt, The Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another weekend email from The Simple Side. This week we are talking oil. That is the only thing happening in the world right now, at least it seems that way. Let's get into what we're doing about it.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, like I said, oil is the only and really the main thing everybody is talking about right now. A lot of oil experts coming out of the woodwork all of a sudden. Of course, we shouldn't be surprised. People are trying to sell to you. And the best way to sell to you is by doing what? Oh, selling fear and greed. We talk about it all the time. And this should come as no surprise to anybody. If you're listening to this on YouTube, Spotify, Apple Music, any of those things, a podcast player somewhere, you should go jump over to thesimpleside.substack.com because you can follow along in the newsletter. If you're a free subscriber, at least you can follow along in the free parts. If you're a paid subscriber, you know that we don't do a podcast on that specifically, but we let you go and read it on the newsletter. And of course, you can join and get access to all this stuff that we're talking about if you go over there and subscribe. The one thing that I want to highlight is that in our subject line of this week's newsletter, we said everyone thinks the world is ending because oil is going ballistic and the war isn't showing signs of stopping or completion. However, we think that's wrong. In 18 months, oil is going to be less than $100 a barrel. I'm almost willing to promise you, but of course, this isn't investment advice, as you heard earlier. These are just my personal thoughts and opinions, so I can't promise you anything. But I really don't think it's something that we should be losing our minds, nor should we be losing our money over it. The big thing, the big piece of news everybody's talking about is the Strait of Hormuz, or Hormuz, whatever you want to say, which has been in a strict lockdown since the issues with Iran started. Currently, the Strait has been deemed the world's most expensive parking lot by a few people here on Substack and across the internet as a whole. And of course, that's because all the ships that are parked on either side of the Strait that cannot pass through right now, of course, they're just sitting there making the world's most expensive parking lot. I included a screenshot in the newsletter, which will probably be the cover page of this week's newsletter as well, which is taken from marinetraffic.com, and it shows all of the ships that are stopped on either side of the strait. And if you go look at that, you will see why I'm calling it the world's most expensive parking lot. And I want to just give you some key stats on what's been happening at the strait and why it matters so much. The daily amount of oil that goes through the strait is about 20 million barrels and other crude products per day. This represents about 20% of the global consumption and about nearly, I think, 25% of all seaborne oil. That's reported per the BBC. The war has been going on for about 22 days now, which means about 440 million barrels of oil have been unable to move throughout that duration. In general, this seems like a drop in the bucket if you think about the fact that we use over 37 billion barrels of oil annually. However, if you annualize the average daily amount that passes through the strait, you end up with about 7.3 billion barrels cut from the world supply. Of course, this is about 20% of that 37 billion number that we use annually. And so that's where that 20% number of global consumption comes from. Now, this matters a ton for a few reasons. The main one is the inelastic demand that the world has for oil. In other words, regardless of what the price of oil gets set at, the demand remains relatively the same. It has little change. This means regardless of whether oil is $2.50 at the pump or $4.50 at the pump, the amount of people driving, for example, tends to remain about the same. You don't stop driving to work just because the price of gas has nearly doubled. We just complain about it a lot. Oh, excuse my alerts going on there in the background. This just means that oil suppliers end up making a ton more in profit because they sell roughly the same amount of oil just for much higher prices. And it's super easy to see this translate to the market and oil companies in general. The other problem that we see with oil is that when oil prices go up, basically everything else goes up as well. And so another thing I've included in the newsletter is a screenshot of the 1 week return for all the sectors in the S&P 500. You'll see that all of them are red. All of them are red except for energy. Energy is the only one that's up, and it's up substantially relative to all the losses. Energy is up 2.46%, while almost everything is down, I would say, averaging 2% in the opposite direction. The S&P 500 down about 1.8%. So it's pretty crazy to see the effect that it has across the entire market. Of course, the main issue causing oil to remain elevated is Iran's unwillingness to back down. It's forcing Trump to remain involved and is almost entirely decreasing the taco ability, the Trump always chickens out ability that we've seen from Trump in the past couple of months. I'm not going to get into politics and all that stuff. Go do whatever you want to do. This is a financial newsletter and podcast, not a political one. Regardless, that begs the question, do we start going long oil? Should we start shorting oil? I just said in 18 months, price of oil is going to be down, and yet I've invested in some companies that are oil picks, if you will. And like I said, you're going to hear a bunch of self-proclaimed investment gurus throwing opinions around and commentary being thrown around out there like they've been in the oil business for years. I haven't been. I don't proclaim to be, but I do have a recommendation. Don't listen. Don't listen to them. And really that sticks for me as well. You don't have to listen to me. I'm going to give you my opinion. I'm going to tell you what I'm doing, and then you can throw stones and poke fun at me if I'm wrong. But one of the things I just recently saw was a large publication on Substack telling their subscribers to short oil and go long gold. And if you've been paying attention at all to what's been happening recently, you'll know that that is terrible advice. Terrible, terrible advice. Gold is down. So there's your go long gold going in the wrong direction. Oil's up. So there's your oil short, again, going in the wrong direction. If any of their subscribers followed that advice that was given to them, I mean, they could have lost substantial sums of money right now. Substantial sums. And maybe there was more nuance to the bet that they were telling their subscribers to make. But in general, that's a ridiculous amount of money. If you're shorting and going long at the same time and both go the wrong direction, I mean, your portfolio is going to be crushed. Crazy. And so that's what I'm saying. Be careful who you listen to, or do not listen at all. Maybe watch and pay attention, but don't listen. Again, these people make money selling fear and greed to you. And a lot of them are not willing to disclose the positions that they have, or they'll just tell you, hey, I have this position, and there's no way of proving whether or not it's true. So just be wary. One of the notes that I would like to make is that we've been sitting on nearly 50% cash for almost a year now, maybe a year and a half. I'm not sure when exactly we disclosed our 50% cash position. But we have recently executed some trades deploying between 20 to 30% of our cash in some undervalued names, a few of those in the oil or energy space, and a few other undervalued names in an assortment of sectors. And I love the positioning that I have right now. It's important to note that when oil spikes, there's almost always risk for a black swan event to occur. Of course, we have OPEC managing basically oil supply across the globe. And there's always the risk that Trump just decides to randomly pull out of a war. We put boots in the ground in Iran, forcing things to open, which could just send prices off a cliff back down to $65, $50 a barrel even. And that black swan event, while I don't think is likely right now, is always possible. However, if that does happen, the 50% of holdings that we have in our portfolios, tech growth, AI stock, secondhand effects, and the flagship fund, those will all benefit. And so our positioning with 20 to 30% of our cash going into a little bit of oil and a little bit of undervalued investments means that we're going to have protected downside if oil stays where it's at, and we'll have limited losses on that 20 to 30% of our cash if the other 50% starts to rocket up in value, if we do see a black swan event and oil just come crashing down. Currently, I think we're going to see the war remain at a standstill, and I think we'll see $80+ oil through the end of the month at least. Again, these are just my personal opinions. Don't go and invest based off of these. This is just how I think and how I'm positioning my portfolios. I think Iran is kind of calling the bluff on Trump right now, and I think it's working relatively. And so again, I think we're at least going to see $80 plus through the end of the month. Even if OPEC steps in and really starts to open up supply, I don't think it's going to change things too terrible much, especially with all the threats of us bombing energy plants and Iran potentially tightening up the strait even more than it is tightened right now. Again, for those of you that might not know, current portfolio composition is 50% in our portfolios, 25% in individual bets. Again, between 20 and 30% right now, but about 25%. And then 25% in cash or cash equivalents, T-bills, etc. Again, like I said, minimal exposure to high upside oil and gas investments and low risk quality businesses with medium exposure there. And again, this is how we like to run our barbell centric portfolio. Low risk on one side, high risk, high return on the other side, and we expect that over time to outperform the S&P 500. We've done it so far. Hopefully that continues. And again, here's my little quote. I can almost guarantee you over the next 18 months, the price of oil will come down. I don't think it's going to remain there. And I even said, yes, quote me on it, because I would love for you to call me out if I'm wrong. Again, we have oil bets that if it does happen that way, I think will easily outperform the broader market and return vast amounts to those invested. So even if I'm wrong, the portfolio will end up benefiting regardless. One final thought that I have is that in the end, after all of this oil stuff goes away, I think you're going to see a lot of people questioning, how can we reduce our reliance on exterior energy sources? Because this has been such a hit to the market. Someone like Trump, especially, who's been pounding the table on America first, you're going to see him start to say, I want to get rid of this reliance. This is, BS that we had our market getting crushed while this happened. This shouldn't happen, blah, blah, blah. How can we put energy supply onshore? And I think what you're going to see is the alternative energy sector benefit heavily from this. I think specifically nat gas and uranium are going to be the big places that we're going to see investments run into. And I think there's a secondary tailwind here, which is the AI build out and the AI energy demand. And so I think we really could see a 2 to 3 year bullish run into energy build out, energy sectors, energy demand. And I would not be surprised if that's the case, and we see huge infrastructure investments, energy related as well, in the US. And I still think this bodes very well for our AI secondhand effects portfolio, which is heavily invested in AI energy and infrastructure of that nature. Sorry, I'm stopping to drink some water in between talking here. That's kind of all that I have for free subscribers here. Not super in-depth, but that's what you guys pay me for, right? You pay me to be more in-depth and give you better ideas. If you're a free subscriber, you're probably just sticking around to see what it is exactly that I'm looking at and talking about. Of course, I'm always going to recommend that you join paid. I think it's very valuable. Whether you follow my investments or not, I think we offer a lot of good insight into ideas that we're looking at, and we might not hit the ideas 100% on the head, but I think you can at least follow along generally with what I'm doing, and you'll probably end up ahead of the broader market. many folks that follow the portfolios, follow the weekly picks that I have, etc., do just that, and they come out on top for sure. If you're listening to the podcast, I'm going to give you a quick look into all the one-off bets that we have. This is, again, 25% of our portfolio right now, higher upside, but a place that we think isn't going to lose us a ton of money, especially with the oil names. We added 2 new picks this week to the one-off bets that we have. One of them is an oil pick. If you're going to invest in this pick, and this is for paying subscribers as well, you need to have a brokerage account with either Schwab or Fidelity or someone that lets you trade on OTC, over-the-counter stocks. You can't buy this on a Robinhood, and I'm not sure about like a SoFi. If you're able to invest in it there, if I had to guess, I would be doubtful. But a Schwab or a Fidelity, those kind of places will let you get into these. And then we also have kind of an AI build-out play that we're betting on as well that's been oversold based on current news that hasn't directly affected the stock. And so go check those out. In total, let's see how many bets that we kind of have outstanding. 1, 2, 3, 4, 5, 6, 7, it looks like. Yeah, we have 7 outstanding one-off research reports. Again, about 25 to 30% of our available cash is invested in these. And some of them are a bit longer term, some of them are shorter term. But in general, we have, I think, pretty substantial upside in a lot of these names. I try to call out for you, if you're a paying subscriber, which ones are higher risk and which ones are kind of a more medium risk. We do have one pick that sometime this week we'll be announcing whether they're going to be buying out investors or whether they're going to have to be diluting their shares. If they do not dilute shares, we will be looking at substantial returns from the current stock price. 50 to 90%, honestly, seems reasonable here. That sounds crazy, but it's a very undervalued oil and gas play, specifically oil. And so, we'll have to see how that plays out. If they don't pay out the Series F investors, we're down about 20 to 30% on my initial buy price. I don't think there's much more room to run down from there. Maybe we'll go down to about 50% and we'll have to take a large loss. But I called out and mentioned this was a very high risk play, high risk, high reward. And so be prepared for losses. And I think initially I called out losses between 20 to like 80%. I knew there was substantial downside if dilution were to occur on these Series F investors. So just be paying attention to that. If you are one that buys or pays attention to our weekly picks, a lot of these are oil energy focused. A lot of them are the names that we have are longer term picks in, and then a few random ones shuffled in there. But go and check all of that out, guys. Short one this week for you, short podcast. I've been trying to shorten these down. I've got a thing in the newsletter where you can fill out a survey and let me know thoughts and opinions that you have. If you like the shorter format, if you want a longer format. I slid away from my microphone here. I'm just going to search real quick and see if we have any unanswered questions sitting in there that I think are important to get to. Let me just throw this up real quick. Let's see. So we have someone asking how we're implementing our trailing stops. We're trailing our stops at a negative 1%, but we don't just instantaneously sell at 1%. We usually wait 20 to 30 minutes to see if it comes down any further than that before we sell. And then someone asked and said, I've been unable to get the various shares in your folios. I'm not sure exactly what that's referring to. I've been unable to get the various shares in your portfolios. If you're saying you've been unable to see the picks that we've been making, I don't know how to help you there. We have a website that houses all of the stocks that we have researched and portfolios both. We also have everything on autopilot. I'm not sure exactly how to answer that. Email me directly if you have any questions as well. thesimplesidenews@gmail.com, and I'll get back with you on all that kind of stuff. All right, guys, that's all I got for this week. Thank you so much. Again, fill out that form if you have questions. I don't know how to answer questions if I don't have those. And feel free to leave an email in there as well. Let me know, hey, this is my email. Reach out to me at this email, and I'm happy to help with all that stuff. That's all I got for you this week, guys. I'll be seeing you soon. Bye.